Take us through what's a key takeaway from the bond market? I mean, there seems to be expectation that the Fed will be forced to raise rates faster than anticipated.
Well, Haslinda, you're right to say that basically the market focused very much on the inflation prints, and they have been coming a little bit higher than what we were been expecting. So that casts some doubt on, the central bankers' rhetoric that inflation is going to be transitory. I think the case here really is that if you look in the case of the US, right, fiscal policy is still expanding with all the fiscal packages coming from the Biden administration. Monetary policy, while they have managed to avoid a taper tantrum, whether they can avoid an interest rate tantrum going ahead is another issue altogether. But the Fed, they basically said that they want to have an average inflation targeting framework. So they're going to let inflation run hotter than usual in the interim. But market doesn't believe that this is going to happen. I think once we see inflationary expectations being entrenched and being embedded, I think the Fed will have a much, much tougher job of trying to convince markets that they are ahead of the curve. So you're right to say that bond markets will have a very, very challenging time ahead. And I don't think there's going to be any near-term resolution on this. So although we saw recently there was some pushback from Powell and also from the Bank of England on all these very aggressive interest rate expectations, but it's still going to be very much market versus the central banks going ahead from here.
What's your inflation hedge then, Selena?
Well, a lot of people are looking at inflation hedges like precious metals, gold, for instance, and even alternative assets. So crypto has been getting a little bit of wind in sails recently. I think the issue here at the end of the day is that interest rates have to rise. It's a question of the timing. And so far, the Fed wants to delay it for as long as possible in order to ensure both growth and the inflation levels return to sustainable levels into 2022 itself. Market may not give them that long a window. We do think that probably the inclination is that they will have to start to hike rates by the second half of next year. But whether they will hike once or up to 2 or 3 times is what the futures market has really started to price in. It's still a matter of debate, and it would really very much continue to depend on the labour market going ahead. We have seen that the unemployment rate has dropped to 4.6%, but total jobs remain about 4.2 million below pre-COVID levels. So once this gap starts to close, it's very likely that we're going to see pressure return again to the bond market to pressure the Fed to act ahead rather than behind the curve.
So, I mean, the question is, what's it pricing in right now? If you look at the yield curve, and if you look at the tips curve as well, with the negativity there, would suggest that a lot of people are taking out a lot of protection against inflation. So is there a disconnect between the Fed and the market?
Definitely. I think this disconnect is really growing. Given the negative real yields, I think at some point there would be continued upside pressure for the nominal yields to rise. So our 10-year treasury yield range that we're looking at is still around 1.55 to 1.75%. So there's still a little bit more room to go. And I think as we get into the whole issue about, where's the financing for the $1 trillion infrastructure package going to come from, probably you're going to see further upside pressure into the end of this year and the start of 2022 as well.
So, Selena, that takes us to our question of the day. How low can U.S. real treasury yields go? It's already in the negative.
I do see that probably there's going to be limited downside from here. At some point, the recalibration really has to happen more on the nominal yield side. That's why I think that we will probably see a push higher in the nominal yield back towards the 1.7, 1.75% range for the 10-year treasury yield. I think at this juncture, market's still trying to test the resolve of the central banks to hold off rate hikes as far as the Fed is concerned. I think at some point, we're already starting to see a bit of a split in terms of the central bank itself. And it'll be quite interesting to see who President Biden actually nominates for the new Fed chair, because I think that would kind of set the tone for the monetary policy stance we may get from around February or March onwards next year. So if it's going to be Brainard, I think the sense is that she's still going to be fairly dovish, quite aligned with Powell, but we will just have to wait and see.